September 3rd, 1929. Irving Fisher, one of America's most respected economists, made a declaration that would haunt economic history. Stock prices have reached what looks like a permanently high plateau. 8 weeks later, the market collapsed. Within 3 years, 89% of wealth was destroyed. 9,000 banks failed. Unemployment hit 25%, and the people who believed in the new era lost everything. Now, I keep asking myself one question. If the warning signs were visible months before the crash, if production was slowing, if unemployment was rising, why did everyone keep buying? My theory is this: they saw the signs, they just believed this time was different. And right now, in 2025, I'm seeing the same pattern, the same psychology, the same structural fragility, and the same belief that somehow we've escaped the rules of economic gravity. Let me show you why I think we're closer to 1929 than anyone wants to admit. I'm not a financial advisor. This isn't financial advice. This is pattern recognition based on historical market data, leverage metrics, and crash mechanics analysis. And what I found suggests we're not in the early stages of a bull market. We're in the late stages of a cycle that's played out 3 times in the last century, and every time the people who saw it early survived. Everyone else wondered what happened. Let me give you the pattern first, because once you see it, you'll recognize exactly where we are. It's 4 stages, always. Stage 1 is foundation. New technology emerges. Productivity increases. Genuine economic growth creates legitimate wealth. Optimism is rational. Prices reflect improving fundamentals. This is real. This is healthy. This is how bull markets should work. In the 1920s, this was electrification, automobiles, radio, mass production, real innovations creating real value. In the late 1990s, it was the internet. In the 2010s, it was mobile computing and cloud infrastructure. In 2023-2024, it's artificial intelligence. Every cycle starts with something real. Stage 2 is leverage. Once prices are rising, human psychology takes over. People don't want to miss out, but they don't have enough capital to fully participate, so they borrow. In 1929, you could buy stocks with just 10% down. That means $1,000 in cash controlled $10,000 in stocks. If stocks went up 10%, you doubled your money, but if they fell 10%, you were wiped out. And here's the mechanism that makes this catastrophic. When prices fall, brokers issue margin calls. You either put up more cash or they sell your shares. And when everyone gets margin calls simultaneously, everyone sells simultaneously. That's not a correction, that's a cascade. Stage 2 is when leverage transforms a market into a time bomb. Stage 3 is detachment. Prices decouple from fundamentals. Earnings growth slows, but stock prices accelerate. Valuations reach historic extremes, and every warning sign gets dismissed with the same phrase. This time is different. In 1929, it was new era economics. In 1999, it was the internet changes everything. In 2007, it was housing never goes down nationally. In 2021, it was infinite liquidity. And right now, in 2025, it's AI will transform productivity. The narrative changes. The psychology is identical. When prices detach from fundamentals, the system is fragile. One shock, and everything unravels. Stage 4 is collapse. Something breaks. It doesn't matter what. A bank fails. A company misses earnings. A policy changes. The specific trigger is irrelevant because the structure was already unstable. Margin calls trigger forced selling. Forced selling drives prices down. Lower prices trigger more margin calls. It's a feedback loop. And once it starts, it doesn't stop until leverage is destroyed, prices reflect fundamentals again, and everyone who believed this time is different has learned an expensive lesson. Stage 4 is the inevitable outcome when leverage meets detachment. It's not a question of if, it's a question of when. Now let me prove this pattern to you using the most famous crash in history, and then I'll show you why 2025 looks identical. October 1929. The Dow Jones had risen 500% in 8 years. Everyone was invested. Shoeshine boys were giving stock tips. Margin debt was at historic highs. And Irving Fisher, the most respected economist in America, declared stocks had reached a permanently high plateau. But here's what he didn't see. Industrial production had peaked in June, 3 months before the crash. Freight car loadings were declining. Employment was falling. The fundamentals were already deteriorating. But stock prices kept rising. Why? Because prices don't reflect the economy. They reflect psychology. And psychology was euphoric. October 24th, 1929, Black Thursday. The market opened down. Margin calls went out. Forced selling accelerated. By noon, panic. A group of bankers pooled money and started buying to stabilize the market. It worked. Temporarily. The market recovered most losses by close. And that's the critical lesson. Crashes don't happen in one day. They happen in stages. Black Thursday was the warning. Most people thought it was over. It wasn't. October 28th and 29th, Black Monday and Black Tuesday, the market collapsed, down 13% on Monday, down 12% on Tuesday. But even then, it wasn't over. The market rallied in November, regained 20% of losses. People thought the worst was behind them. It wasn't. By 1932, the Dow had fallen 89% from its peak. 89%. If you had $10,000 in 1929, you had $100 in 1932, and it took 25 years to recover to 1929 levels, a generation of wealth destroyed. Here's what I noticed when I studied the 1929 crash. The collapse wasn't caused by one event. It was caused by structure, excessive leverage, extreme valuations, deteriorating fundamentals, and mass psychology that refused to acknowledge reality. The trigger was irrelevant. The structure guaranteed the outcome. And right now, when I look at 2025, I see the same structure. Let me show you the data. Margin debt in the US stock market is currently near historic highs. According to FINRA data, margin debt sits at approximately $750 billion. That's not quite the 2021 peak of $935 billion. But it's substantially higher than pre-2020 levels. And here's what that means. Hundreds of billions of dollars in stock positions are leveraged. If prices fall 10%, margin calls go out, forced selling begins, and the cascade mechanism activates. The structure is identical to 1929. Now let's talk about valuations. The Shiller PE ratio, which measures stock prices relative to 10-year average earnings, is currently around 35. The historic average is 17. In 1929, it peaked at 32 before the crash. In 1999, it hit 44 before the dot-com collapse. In 2007, it was 27 before the financial crisis. Right now, we're at levels that have preceded every major crash in modern history, and the justification is always the same. Earnings will grow into the valuation, except they don't. They never do. Here's the mechanism that terrifies me. When I look at corporate earnings growth, it's slowing. S&P 500 earnings growth for 2024 was approximately 8%. Projections for 2025 are around 10%. But those are projections, not results. Meanwhile, stock prices are near all-time highs. That means multiples are expanding while growth is slowing. That's not strength. That's detachment, and detachment is stage 3. The system is fragile. One shock, and the cascade begins. Now let me show you the second historical example, because the pattern isn't unique to 1929. It repeated in 2000, and it repeated in 2008, and it's repeating now. March 2000. The Nasdaq peaked at 5,048. The internet was going to change everything. Valuations didn't matter because earnings would eventually justify prices. Except they didn't. By October 2002, the Nasdaq was at 114, down 78%. Trillions in wealth destroyed. And the people who believed this time is different learned the same lesson as 1929. Leverage plus detachment equals collapse. But here's the part everyone forgets. The warning signs were visible months before the crash. In late 1999, several high-profile internet companies missed earnings. Funding for startups was becoming harder. Revenue growth was slowing, but stock prices kept rising because psychology was still euphoric. And then in March 2000, something broke. It wasn't one specific thing. It was the collective realization that valuations were unsustainable. And once that psychology shifted, the cascade couldn't be stopped. Now, 2008, a different trigger, same mechanism. Housing prices had risen for years. Everyone believed real estate never went down nationally. Banks leveraged those mortgages into complex securities. Ratings agencies gave them 8AA ratings. And when housing prices started falling in 2006, everyone said it was contained. It wasn't. By September 2008, Lehman Brothers collapsed. The financial system froze, and the S&P 500 fell 57% from peak to trough. Same pattern. Leverage. Detachment from fundamentals. Belief that this time is different, and then collapse. 3 examples. 3 different triggers. Same 4-stage pattern, same outcome. And every time, the warning signs were visible months before the crash. But people ignored them because prices were still rising. And that's what scares me about 2025. Let me show you what I'm seeing right now. First, technology narrative. In 1929, it was cars and electricity. In 1999, it was the internet. In 2007, it was financial engineering. Right now, it's AI. And the psychology is identical. AI will transform productivity. Earnings will explode. Valuations are justified by future growth. Maybe. Or maybe AI is being used to justify unsustainable valuations the same way every other technology narrative was used. I don't know. But I know the pattern. And the pattern says when technology narratives are used to justify extreme valuations, crashes follow. Second, the everything bubble. In 1929, it was stocks. In 1999, it was tech stocks. In 2007, it was housing. But in 2025, everything is inflated simultaneously. Stocks at record highs, housing prices elevated, commercial real estate stressed, private equity valuations extreme, crypto volatile but substantially higher than historic norms. When multiple asset classes are inflated at the same time, there's nowhere to hide when the cascade starts. That's not a stock market crash. That's a systemic deleveraging event. Third, consumer fundamentals. Household debt is near record levels. Credit card debt exceeds $1 trillion. Auto loan delinquencies are rising. Savings rates are at historic lows. Consumer spending drives 70% of GDP. If consumers are tapped out, spending falls. If spending falls, earnings fall. If earnings fall, stocks fall. And if stocks fall, margin calls trigger forced selling. The consumer is the foundation of this economy, and the foundation is cracking. Fourth, corporate behavior. Stock buybacks are at record levels. Companies are borrowing money to buy back their own shares, artificially inflating prices and earnings per share. When the cycle turns, when revenue declines, those buybacks stop, and the artificial support disappears. That accelerates the collapse. Now let me show you the divergence that concerns me most. Corporate profit margins are near historic highs, around 12% to 13% for the S&P 500. The historic average is closer to 9%. That 3% to 4% difference represents extraordinary profitability. But here's the question. Is that sustainable, or is it the result of temporary factors like low interest rates, globalization, and weak labor bargaining power? If it's temporary and margins revert to the mean, earnings fall 25% to 30%. And if earnings fall 25% to 30%, stock prices need to fall proportionally to maintain valuation ratios. That's not a correction. That's a crash. And the trigger could be anything. Rising wages, recession, policy changes. The specific event doesn't matter. The structure is fragile. Here's what I think happens next. And I'm not predicting a specific date. I'm outlining the sequence based on historical pattern. Stage 1, peak confidence. We might be here right now. Stocks near all-time highs. Optimism pervasive. AI narrative dominant, retail participation high. Everyone believes the bull market continues. This can last months, even quarters. But fundamentals are already deteriorating underneath. Stage 2, initial break. Something fails. A major tech company misses earnings significantly. A bank has trouble. A geopolitical event disrupts markets. The specific trigger is irrelevant. What matters is the market's reaction. If we're in stage 3 detachment, any shock can trigger forced selling. Margin calls go out. Leveraged positions get liquidated. The market drops 10% to 15% quickly. Stage 3, the rally. This is critical. After the initial drop, the market rallies. Maybe it recovers half the losses. Everyone says it was just a correction. Buy the dip becomes the mantra. But underneath, the fundamentals haven't improved. Margin debt is still high, valuations are still extreme, and the forced selling has revealed fragility. This rally is a trap, and historically, the people who buy this rally get destroyed in stage 4. Stage 4, the grinding collapse. The market rolls over. It doesn't crash in one day like some people imagine. It grinds down over months, sometimes years. There are brief rallies that give hope, then more declines. Eventually, valuations reach historic lows. Leverage is destroyed, and only then does the market stabilize. In 1929, this process took 3 years. In 2000-2002, it took 2.5 years. In 2008-2009, it took 18 months. The timeline varies. The mechanism is identical. Now, I'm not saying this happens tomorrow. I'm not saying I can time the market. I'm saying the structure is fragile. The pattern is recognizable. And historically, when we've seen this combination of leverage, detachment, and euphoria, crashes have followed. Maybe this time is different. Maybe AI really does transform productivity in ways that justify current valuations. Maybe consumer debt doesn't matter. Maybe margins stay elevated forever. Maybe. But the pattern says otherwise. Here's what concerns me most. In 1929, there were warning signs months before the crash: production slowing, employment falling, credit tightening, but stock prices kept rising because psychology was disconnected from fundamentals. Right now, I'm seeing similar divergence. GDP growth is slowing, consumer fundamentals are weakening, corporate earnings growth is decelerating, but stock prices are near record highs. That gap is the fragility. And the wider that gap gets, the more violent the reversion will be. Let me show you one more data point. In 1929, the top 1% of Americans owned approximately 45% of the nation's wealth. Extreme concentration. When the market crashed, the wealth destruction was catastrophic because so much was concentrated in financial assets. Today, the top 1% owns approximately 32% of wealth, and the top 10% owns around 70%. Wealth concentration is extraordinary, and most of that wealth is in financial assets: stocks, bonds, real estate. If those asset prices collapse, the wealth destruction will be concentrated at the top, but the economic consequences will hit everyone through reduced spending, business failures, and unemployment. That's the mechanism that turned a stock market crash into the Great Depression, and that mechanism is active right now. Now let me talk about central bank policy, because this is the variable that's different from 1929. In 1929, the Federal Reserve tightened policy into the crash, making it worse. In 2008, the Fed cut rates to 0 and implemented quantitative easing. That prevented a full deflationary spiral. So the question is, can central banks prevent a crash this time? My answer is, they can delay it, but they can't prevent it. Here's why. Central banks can provide liquidity, they can lower interest rates, they can buy assets, but they can't fix structural problems. If valuations are extreme, if leverage is excessive, if fundamentals are deteriorating, monetary policy can only delay the adjustment. Eventually, reality reasserts itself, and the longer the delay, the worse the crash when it comes. Here's the mechanism. When central banks cut rates, they encourage more borrowing, more leverage, higher asset prices. That feels like it's working, but it's making the underlying fragility worse. It's like giving painkillers to someone with a broken leg. The pain goes away temporarily, but the injury is still there. And if they keep walking on it, It gets worse. That's what central banks have been doing since 2008, providing liquidity to mask structural problems. And those problems have compounded. Debt is higher, valuations are more extreme, leverage is greater. So when the adjustment comes, and it always comes, the magnitude will be larger than if they'd allowed smaller corrections along the way. Now let me give you the risk reduction framework, because I'm not telling you to sell everything and hide in a bunker. I'm saying reduce fragility in your own financial structure. First, reduce equity exposure. If you're 100% in stocks and the market falls 50%, you've lost half your wealth. If you're 60% in stocks, you've lost 30%. The math is simple. Reduce exposure, reduce risk. Second, eliminate leverage. If you're buying stocks on margin, stop. If you have HELOCs or investment loans, pay them down. Leverage magnifies gains, but it also magnifies losses. And in a crash, leverage destroys you. Third, hold cash. I know cash earns nothing. I know inflation erodes it. But in a crash, cash is king. When everything is falling, cash lets you buy assets at distressed prices. It's optionality. It's survival. Fourth, consider gold, not as speculation, but as insurance. Gold has no counterparty risk. It's held value for thousands of years. In a systemic crisis, it's a hedge. Not a get-rich play, a preservation play. Here's what I'm not saying. I'm not saying sell everything today. I'm not saying the crash happens next week. I'm not saying I can time the top. What I'm saying is the structure is fragile. The pattern is recognizable. And historically, when we've seen this combination, crashes have followed. Maybe I'm wrong. Maybe this time is different. But I'd rather be prepared and wrong than unprepared and right. Let me show you the final parallel. And this one gives me chills. In September 1929, economists, bankers, and government officials were saying the economy was fundamentally sound. Production was strong, unemployment was low, the future was bright, and stock prices reflected that optimism. But underneath, cracks were forming. Production had peaked, credit was tightening, speculation was extreme, and 8 weeks later, it all collapsed. Right now, in 2025, I'm hearing the same language. The economy is strong, corporate earnings are solid, AI will drive the next wave of growth. Maybe. Or maybe we're in September 1929 and the cracks are already forming underneath. Here's the pattern. Crashes don't happen because of news. They happen because systems become fragile. And right now, the system is fragile. Leverage is high. Valuations are extreme. Fundamentals are diverging from prices, and psychology believes this time is different. That's the same combination that preceded 1929, 2000, and 2008. And every time, the people who saw the pattern early survived. Everyone else learned an expensive lesson. So here's my question. Are you going to wait until the crash happens and wish you'd prepared? Or are you going to recognize the pattern, reduce fragility, and position for survival? Because the pattern is clear, the structure is fragile, and history doesn't repeat, but it rhymes. And right now, it's rhyming with 1929, and that should terrify you. If you want to follow this as it unfolds, subscribe. Because the crash isn't a single event, it's a process, and understanding where we are in that process matters. The people who see the pattern early don't just survive, they thrive. Everyone else wonders what happened. Don't be everyone else.